essential session of the evening, which you surely can't miss. We are pleased to welcome Mr. Vinod Kothari, partner at Vinod Kothari Company. He will provide an in-depth analysis of changes in corporate laws, financial markets, and capital markets. Mr. Kothari, a fellow of the Institute of Company Secretaries of India and associate of the Institute of Chartered Accountants of India, brings over 35 years of expertise in corporate law. He is renowned authority on company law and has been specialist editor of Ramayya's Company Law. His notable publications include Understanding Companies Act 2013, Guide to Independent Directors and Corporate Boards Committee, and Policies under Companies Act 2013. As a consultant, Mr. Kothari addresses a wide range of corporate law issues and advises leading companies nationwide. He frequently speaks at forums on topics such as related party transactions, CSR, and secretarial audit. His lecturing experience spans numerous countries, including the USA, UK, Italy, Germany, UAE, Singapore, and more. A very warm and cordial welcome to sir. The platform is now yours to lead.
Thank you very much, Ridhima. Thanks a ton. I would just put my screen on so that we are able to structure this a bit. But let me first start by thanking Taxmann for giving the opportunity, and let me congratulate all the marathoners who are running this long marathon. As in case of every marathon, the sturdy and the hardy are the ones who last till the end. So I'm sure those who all are still staying back today are the hardiest and the sturdiest of the lot. And I'm sure to stay till the end of my presentation would probably be awarded by Taxmann as the marathon winners. And like the previous speaker just mentioned, vaccination is on the way. So I think in my case, all I would say is that some bit of water, some bit of refreshments are probably on the way. So please do hang on and stay for this presentation, which would capture some significant budget proposals, which might impact the corporate sector, which might impact the economy in general, and which would generally be of interest to everyone. So let's get this started straight away, because it's been a very, very long day for you. And this is what I'm going to talk today. I'll start with the provision dealing with share buybacks. I'm not sure, and I definitely can imagine that somebody during the day might have talked about it. Yeah. My perspective would be correct, Ridhima. My perspective will be still a little different, and therefore I would still want to talk about it, because this is something which is going to impact the corporate sector. And I would say among all the provisions of the budget, this one can actually be singled out, and I'll explain why. And then we'll talk about the internship scheme that companies may participate. This is quite a lot talked about, something which will generate 1 crore jobs over the next 5 years. Use a job creation opportunity, but what exactly does it mean to the corporate sector? What does it mean to the country? We'll talk about that. And then another provision which was talked by the finance minister during her budget speech was variable capital companies. What are they? What do they mean? What would they result into? Subvention of educational loan, not likely impact of the subvention scheme. We would obviously not know the details of any of these schemes, but these schemes would obviously be launched after the budget is approved. But we have some cues from similar subvention schemes in case of home loans. So let's talk about what do they mean. Very, very important provisions for SMEs as self-financing credit guarantee fund, and then guarantees for loans to SMEs which are tagged as what you call special mention accounts. What do they mean? And then we little mention about the amendment of section 47 of Income Tax Act dealing with gifts. It now restricts to gifts by individuals, and therefore what happens to gifts to companies? Is there a likely impact on companies because of that? Let's talk about that. And finally, we will talk about the important change about fund management entities out of International Financial Service Center, so-called GIFT City. What impact will it have on the fund management industry? But let's first get started with the provisions on share buybacks. I said this is a one budget proposition which can be singled out of the entire budget. The rest of the entire budget is extremely development focused. There's absolutely no doubt that the entire budget, you could probably have difference of view when it comes to taxation on capital gains. And I'm sure speaker after speaker today might have, had some things to say, less good things and more less good things about the taxation on capital gains. The entire capital market probably feels hurt on these changes, but there might be a viewpoint, because remember that this was talked about in the economic survey as well. If somebody cared to read chapter 2 of economic survey, there were indications. The government is not very happy with the huge amount of young individuals investing in stock market, particularly those investing in derivatives. So as regards changes in capital gains, well, I'll reserve. I don't have opinions. I'm not intended speaker on this topic. I'll reserve my comments on that. But the rest of the entire budget is extremely development focused, be it educational loans, or be it the provisions for SMEs, or be it provisions for farmers, something that talks about 1 crore farmers being encouraged through natural farming, provisions dealing with the production linked incentive scheme, which is also supposed to be broadened, provisions about liberating FDI, whole amount of provisions which are extremely visionary, far-reaching in impact, which are foresightful. However, in the midst of the entire scheme of the budget, this is something one gets surprised. Where did this come from? Who advised the finance minister? I'm not sure what was running in the minds of those who advised the finance minister on this provision. Now, innocuously stated in the finance minister's speech was there was a recommendation from SEBI's working group that the taxation base for share buybacks may be shifted from companies to shareholders, which is actually true. There was a recommendation from a SEBI group that the current taxation base, where the companies pay tax on share buybacks, the tax is paid on behalf of the shareholders. Shareholders don't pay the tax, the companies pay the tax. That is inequitable. Why inequitable? Because those who are staying back in the company are paying the taxes. Those who are going away are getting a tax-free income. So supposing I am the one going out, I'll probably get a tax-free income. The one who's staying back is paying the tax. That's the inequity part. But did the SEBI consultation paper ever say kill the entire scheme of buybacks? But what's actually proposed is no short of a death sentence to share buybacks, which is why we said it's now bye-bye to buybacks. Buybacks will, unless the finance minister buys back the proposal, rolls back the proposal, it would simply be a bye-bye to buybacks. The buybacks will cease to exist because, as I'll just demonstrate, the entire economics of share buybacks is completely gone. First, let's try understanding a little bit of history, and I don't think history is of great interest to everyone. But let me very, very quickly say these provisions were there since quite some time. 2013, buybacks for unlisted companies were introduced. In 2019, they were extended to listed companies as well. 2024, the present change. The three sections which actually matter: 115 QA, which is the present section dealing with buybacks; 115 O, which is dealing with dividend distribution by companies; 10 by 34A, under which shareholders get exemption; and section 46A, which talks about capital gains to shareholders. These are a bunch of sections which are impacted. We did mention about the SEBI consultation paper. That consultation paper is fairly recent. It talks about aligning regulatory requirements with the changing market dynamics so as to enable efficiency of the buyback process. It's not talking about introducing a complete deadlock to buybacks. It's talking about making it more efficient, making it more equitable, making it more aligned with the objective of promoting buybacks. So all this consultation paper was basically for promoting buybacks. And it recommended shifting of tax base, which is what I mentioned, from the company to shareholders, because that is more equitable, as those who are going out, those who are receiving the money, are the ones paying taxes, not those who are staying back in the company. But those are ones who are anyway not receiving the money at all. Now, I said this is a provision which is completely going to kill buybacks. Before we get into that, let's try understanding, is there any kind of an offense? Is there any kind of a foul intent or a tax planning gimmick or some kind of illicit or unfair use of share buybacks by companies? True that every provision of taxation law can be misused or exploited by companies. And we are all aware that there are very large companies which have come up with schemes of arrangement under which bonus preference shares were issued. Probably the preference shares are intended to be bought back or redeemed. And that might probably be some tax arbitrage opportunity there. But in general, was share buyback being used by companies as a kind of a tax planning gimmick? It doesn't make sense. It couldn't have made sense. Why? Because the tax rate itself, when a company does a buyback, and on the buyback, the company pays excess over the issue price. What actually happens? The company buys back the shares. The company pays the fair value of the shares. The fair value of the shares may be higher than the issue price, And if the company pays the fair value, which is higher than the issue price, then the excess, that's what is taxable, the excess, that is the excess of the price paid on buyback over the issue price, suffers tax in the hands of the company at a 23.29% tax rate. The company pays 23.29%, which is almost like the tax rate which might be applicable to shareholders in general. The company pays it on behalf of the shareholders, don't pay it, the company pays it. Not with 23.29, roughly 23.3% tax rate. Was there a possibility of tax arbitrage? Were we envisaging that this structure is being exploited by companies to create some kind of tax revenue leakage? Because the tax to be paid by shareholders, the shareholders reported tax on their respective income. Shareholders would probably be liable to pay tax at differential rates. Some of them probably would be smaller shareholders. They may not even be taxable. Some might be taxable at lower rate. In any case, under the alternative scheme, the maximum marginal rate itself is quite low. So 23.3% couldn't have been any kind of a revenue leakage for the government. Therefore, the intent couldn't have been to plug some kind of a tax avoidance device. The intent was simple. It was to shift the base to make it more equitable, which is what the finance bill actually explains it to be. But in the process, now try understanding what has the government done. The government now says what? Whatever amount the company pays on buy, therefore, imagine if a share was issued by the company, say with a par value of 10 rupees, the issue price was say 50, and the company now buys it back for a price of 80. Par value 10 rupees, issue price 50, the company buys it back at a price of 80. So what is the gain the shareholder is making? The shareholder is making gain of 30 rupees. That 30 rupees was earlier taxable in the hands of the company. Now what happens? The entire 80 rupees paid by the company will be deemed to be dividend in the hands of shareholders. The shareholder paid 50 rupees to buy the share. He gets 80. The government says, I'll take the entire 80 as your income. And now this 50 rupees that you paid, I'll treat it as a capital loss. This is what you're trying to say is that I'll tax your capital first. Because I'm taxing the entire 80, so I'm taxing not just the profit, I'm taxing your capital also. And given the fact that I'm taxing your capital, I'll allow you capital loss of the 50 rupees. When do you claim this capital loss? You claim the capital loss only if you have capital gain. If you have a long-term capital loss, probably you'll claim it over the next 8 years. If you have a short-term capital loss, you'll probably claim it only in just about a few years. So in a sense, the entire money distributed by the company becomes income in the hands of shareholders, breaching every fundamental principle of taxability of income. I think let's try understanding that it's unarguable, and probably no one could probably think of any dispute on this. Unarguable fundamental principle of taxation that a taxpayer can be called upon to pay tax on his income. No taxpayer can probably be called upon to pay tax on his capital. His own capital coming back to him. There is a question of tax on that. In the example I gave, I got 80 rupees, whereas I paid 50 rupees, but I'm paying tax on 80 rupees. Next question, assuming that I paid 50 rupees and the company returns me 50 rupees only. In other words, I'm not making even 1 penny of profit. Even then, I'll be paying tax on 50 rupees. Take a even worse case. Supposing the company has lost money and the company is now buying back shares at a price of 40 rupees. I paid 50, the company is buying it at 40. I mean, therefore incurring a loss. However, the government would still say, pay me tax on 40 rupees. And you can claim this entire 50 that you paid as a capital loss, assuming you have a capital gain. They cannot be higher in equity than that because this is completely inequitable. I'm almost certain that the provision will suffer some kind of rollback, some kind of turn back, some kind of what do you call boomerang on that, because if the provision stays the way it is, it's a height of fiscal inequity. Now, this is what the government has therefore done in terms of buybacks. Now, if you were to say, is buyback commonly done by companies? Almost everyone connected with the corporate sector in any manner, large companies, small companies, startups, any kind of companies, would completely agree that buybacks are fairly common. Buybacks are extremely common across the country. I mean, the extent of buybacks by listed companies also quite a lot. Even in case of unlisted companies, data would be available for listed companies, but in case of unlisted companies too, buybacks are quite common. Why do buybacks happen? First, understand, Buybacks might be the device to distribute the company's profits. Like companies may distribute profits either by way of dividends, or companies may distribute profits by way of buybacks too. In case of dividends, there are some restrictions because I can distribute only the profits. In case of buybacks, not only can I distribute profits, I can also distribute the share premium. In fact, in certain cases, I can even do a buyback by issuing fresh capital. So I can issue a fresh capital and do a buyback out of fresh capital as well. So buyback is number one, an important alternative device for companies to distribute profits. More important than that, because profits can be distributed by way of dividends also, but more important than that, companies also use buybacks to scale down their size. See, the important point in case of companies is that unlike partnerships, unlike LLPs, where capital is flexible, in case of companies, capital is fixed. There's no way to reduce capital. In order for companies to reduce capital, companies can, the only option available to companies is to use buyback. In what way can buybacks be used to reduce capital? I can do a buyback of 10% of company's net worth in a financial year merely by passing a board resolution. I can go up to 25% by passing a special resolution. So what mostly companies do is do a 25% buyback in a financial year. Next year, once again, then they can do another 5%. This way, companies can scale down. No one can ever argue that once the capital is introduced in a company, the capital may not be needed. I have brought capital into the company, but then I realized that I don't need so much capital for the operation. So I might want to scale down the company's operations. So buyback is the most flexible way to scale down the company's operations. The only other way, I'm extremely emphatic when I say the only other way for companies to scale down their operation would be to do what is called reduction of capital, which is an extremely tardy process because number one, it requires me to obtain shareholders resolution. Number two, it needs me to go to creditors also and take creditors resolution. Number three, I need to go to NCLT and spend a good number of months to get the NCLT's approval. Buyback, therefore, reduction of capital is not at all a flexible or convenient way, whereas buyback is the most common method for scaling down. That's part one. Part two, buybacks are also very commonly used to allow exit to specific shareholders. Therefore, if I have a bunch of shareholders in the company and I want to allow exit to some while not giving exit to others, companies do buybacks even to provide exits. Many people familiar with venture capital world would also understand when strategic investors or venture capitalists, private equity investors invest money in companies, they have a clause, they have a shareholders agreement saying after X number of years, the company allows the company does what you call a put option. The company grants a put option whereby the company will be ready to buy back the shares of the venture capitalist, of the strategic investor. Now, if buyback results into tax on the entire capital, the entire flexibility of allowing exit to private equity investors or venture capitalists or any kind of strategic investor is once again completely frustrated. Third situation, if the company has issued a compulsorily convertible debenture or compulsorily convertible preference share, there also buyback is only way because it's not possible to do a buyback of something which is compulsorily convertible other than by using section 68. Now one might still argue that if it's a buyback of debentures, maybe the new provisions may still not be applicable because the provision talks about buyback of shares, and therefore technically it will not be applicable to buyback of compulsorily convertible debentures. That's something that companies may still explore to a certain extent, but the way it stands, the way it's now structured, companies would find it extremely difficult to use buyback as a device for distribution of profits, because as you can see in the tabular comparison on screen, if I have two options, buyback of shares versus dividends, you can see that two ramp up extremely badly. You can see here, look at buyback and look at dividends. And as far as dividends are concerned, dividends are only out of profits. I can pay dividend only out of profits, whereas buyback can be done out of paid up capital and free reserves. Source of distribution case of buyback can be profits, premium, or proceeds of a fresh issue of securities as well. In case of dividends, it can be only out of profits. Timing, buybacks can be done any time during the year. Dividends are typically done end of the year. Of course, interim dividends are allowed. Approval up to 10% board resolution, up to 25% shareholders resolution. Dividends can be only board power. Impact on the shareholder, if the company does a buyback as per the new provisions, the the general impact of buyback is the holding, the number of shares held by shareholders comes down. Whereas dividends is merely distribution of profit without impacting the base of the company's capital. Taxability as per new provisions, the entire amount paid by the company becomes taxable. In case of dividends, only the profits. Uses, therefore, buybacks could have been used for scaling down. Dividends are not used for scaling down. Dividends are merely by way of distribution. Now, in case of dividends, the company remains free to issue securities further as well. But in case of buybacks, the company becomes liable not to come with any fresh capital issue over the next 6 months. Now, 115 Q8 has existed versus section 222F, which is sought to be inserted now. The tax is supposed to be paid by the shareholder. Taxability tax rate will be as per the rate applicable to the shareholder. Under the earlier provision, there was no question of any capital loss or capital gain by shareholder. Under the new provision, shareholder will be allowed to claim the cost of the shares as capital loss. And of course, the scope of applicability, earlier provision referred to buyback under any provision of law, whereas section 222F refers to buyback under section 68 only. Before moving to the next provision, let me just quickly talk about some lurking questions on buybacks. First question, when will the provision be applicable from? As the finance bill very clearly says, this provision would be applicable from the 1st of October. Now, this applicability, is it based on declaration or decision of the company to buyback or actual distribution of money by the company? In our view, if the language of the law remains the same, I'm almost sure the language will not remain the same. And I cannot be forecasting this, but legitimately, reasonably, the provision will go for some tweaking for sure, because as it stands, it's extremely inequitable. But the provision remains the same, then because the taxability is on payment made by the company and the date is 1st October, therefore, as long as the payment is received by the shareholder before 1st October, it would be taxable under the earlier scheme. From 1st October, the payment received by shareholder will become taxable under the new provision. Does redemption of preference shares also come under the provision? This has been a lurking question quite earlier. People have quite often argued that redemption of preference shares is also one way of buyback. And therefore, why would this not be covered by section 68? Or why would this not be covered by section 115 QA? In our view, I think, and the provision is now quite clear because it refers to section 68 specifically. Redemption of preference shares does not happen under section 68. It happens under section 55 of the Companies Act. 68 is question of buyback. Redemption is simply redeeming. The preference share was redeemable. It's redeemed. Means it's paid out. It's not a case of buyback. Buyback is for something which wasn't supposed to be redeemable. I buy it back. I cancel it by buying back. Redeemable preference shares are redeemed. That's merely a satisfaction of the obligation to pay money out. Not a case of buyback at all. So the doubt about potential applicability of section 115 QA to preference shares does not persist, does not apply in case of section 222F as proposed to be added now. Next question, can companies now, given the fact that the companies still have roughly about 2 months, can they still quickly finish a buyback and still escape the new provision? In our view, the answer is very clearly yes, because you have 2 months still to go. And if everything is done in good time, an unlisted company can finish buyback in couple of 2 to 3 weeks time. Listed company can still do a buyback in less than about 1.5 months time, because it will need shareholders resolution. You can probably speed up a postal ballot, take shareholders resolution. The entire process can still be done so as to finish the buyback before end of September. Another question which is quite significant is rest of the scheme of section 222 talks about distribution. Section 222, I'm sure as you understand, is relating to deemed dividends. What can the company distribute as dividends? Obviously the profits. 222A to E all talk about distribution. It's only the new clause F which talks about payment by the company. Distribution means what? When the company has distributable profits, it does distribution. Distribution of something which is distributable. But remarkably, section 222F talks about payment, and the government has also given an illustration in the memorandum explaining the provision. where the government itself clearly says the entire amount paid by the company will be taken as dividends. So one cannot read the provisions of clause F in light of the rest of the provisions of section 222 and limit it only to the profits. It would be applicable to the entire money paid. So this, as I mentioned, is a provision which can be singled out as something which is complete, which stands out of the entire scheme of the budget. Let me now quickly come to some other provisions which might be of interest. Let's first talk about the internship scheme. This was talked about by the finance minister. It's been talked about ever since the presentation of the budget. It seems to be an extremely benign, innovative, visionary idea of encouraging companies to take interns. These interns are employed in companies. They work for companies as interns. Companies get good young people to work for companies as interns. The best part is 90% of the cost is paid by the government. Now imagine the extent to which the government is committed to spend money. 90% of the cost of internship is paid by the government. How much do we pay to the intern every year? We pay 5,000 per month. So we pay 60,000. Plus we pay an additional joining fee of 6,000 rupees. 90% of both. That would be out of the entire thing, roughly about 60,000 is paid by the government and only about 6,000 rupees is paid by the company. The interns obviously work for the company. They are trained in the company. Details of scheme are yet to be, some details are available. For example, who can qualify to be an intern. Those details are there though. But rest of details are still work in process. Of course, it will be out only after the budget is approved. But the government is talking about top 500 companies. Now, look at the data and try understanding how does the maths work. We're talking about 1 crore jobs over 5 years. For a minute, assuming that we divide 1 crore by 5 equally, it's definitely not going to be equal because the annexure to the bill also talks about phases, phase 1, phase 2. It's not equal therefore. But for a second, let's take it equally. 1 crore divided by 5 is 20 lakhs. How many companies participate? 500 companies. So assuming every company takes equal number of interns, we're talking about how many? 4,000 interns each company. Virtually impossible. But I can't think the biggest of the companies in the country engaging 4,000 trainees in a year. And for 1 year, remember. It's not going to be a 1 month internship. It's not going like 15 days internship. It's going to be 1 year long internship. 4,000 new interns over a year, almost an impossibility. I'm not sure how is the maths works. We don't know. Now, the best part is that the government has targeted. What is the government's budgetary allocation on that? The government is targeting 19,000 crores over 2 years. If you look at the annexure to the finance bill, it's talking about for the first phase, which is year 1 and year 2, 19 crores of budget allocation by way of the government's 90% contribution. Government will be incurring 19,000 crores. Rest of the money, which is paltry 1/9 of that, just about a smaller portion of that, that would be incurred by companies. And that amount also companies may take it from the CSR fund. Now, the irony here, and see, it's ironical, extremely benign, innovative scheme, but there is something probably missing somewhere in the construct, unless we are missing some details. A, taxpayers' money, your money and my money, to the extent of 19,000 crores is spent by the government. For whose benefit? The interns work for who? The interns, of course, that's extremely, I would say, developmental. 1 crore young students get jobs. Very good. So we are giving jobs at taxpayers' cost. That's perfectly okay. But who are the interns working for? They're working for the likes of the biggest companies. They're working for the top 500 companies. They work for companies. Companies pay 10% of the money. 90% is paid by Ridhima Bhatia and Vinod Kothari. So is this a good use of taxpayers' money? That's the first question. Second question, given the fact that companies have been permitted to use CSR funds for this, to my mind, the best and easiest way would have been the entire cost of internship. If the government permitted the CSR funds to be employed for the internship scheme and opened the scheme to all companies which are liable for CSR. How many companies are liable for CSR, by the way? Not less than 5,000 companies. Probably number would be more. I don't have ready data, but not less than 5,000 companies are liable to spend on CSR. Where do companies spend the CSR on? I mean, the companies go spending on all kinds of stuff. They spend it on cattle. They spend it on building some houses for the police, etc. They spend on weird things. If companies were permitted to use CSR funds for engaging interns, companies will be happy, interns would be happy, the country would have generated employment, and we would not be burning a hole on taxpayers' pockets. So this is something which could probably might need to be reviewed. Though I would say the scheme as such is quite benign and benevolent, but then something missing somewhere. I'll very quickly talk about some of the other provisions that wouldn't take very long time. I know it's the marathon has been very long for you. Variable capital companies. This was talked about by the finance minister. Variable capital companies versus fixed capital. Every company by definition is fixed capital company. The companies that we have currently are not variable capital, they are fixed capital companies, because once you introduce capital, other than the buyback that I talked about, there's no other way to reduce the company's capital. Companies are fixed capital. LLP is a variable capital. Every LLP is by definition variable capital entity. Variable capital companies exist in many jurisdictions, particularly the so-called light regulated jurisdictions. Variable capital companies, for example, exist in Singapore, they exist in Mauritius, they exist in several lightly regulated jurisdictions. They use basically is for forming what is called special purpose vehicles. Currently, because companies have fixed capital, and if we use the company form of SPVs, like in case of most real estate companies, we have SPVs holding properties. The problem with SPVs is once you introduce capital, the capital becomes fixed. It can't be withdrawn. We can't draw the capital out. A variable capital company will have two features. Number one, it will have multiple cells within a company. Multiple cells in a company. Therefore, it's one entity with multiple cells. You can see the picture on the right hand side here. One company with sub fund 1, sub fund 2, sub fund 3. There are various funds or various corpuses, various corpi within the company. Each of the corpi are mutually protected. Therefore, these entities are also called what is called protected cell company. They are also called protected cell companies because every cell is protected against the other. The uses of some protected cell company means that each cell is protected against the other because the assets and liabilities of each cell are distinct. Unlike in case of companies where everything gets commingled into a single entity, in case of PCCs, protected cell companies, every cell is mutually protected. That's part one. Number two, the capital is variable, which means based on conditions, the capital can be withdrawn too. This structure has been suggested by Dr. M.S. Sahu at the instance of IFSCA. The report of Dr. Sahu's committee is available on IFSCA website. Anyone can see it. And incidentally, Dr. Sahu has talked about VCCs today as well. So in a sense, I'm expecting that VCCs will be introduced out of IFSCA, out of IFSC. I'm not expecting variable capital companies to be introduced within the rest of the country. It probably would stay limited to IFSC. And given the fact that it's limited or intended for IFSC, quite likely it would be relevant only for investments outside India. If it's money coming into India, it probably would be taken as money coming by way of from non-residents. Given the time, I would very briefly say that there's the subvention scheme for educational loans. This is again very benign, extremely innovative idea. The PM has been talking about this. Why do we send students overseas when we can have world-class educational institutions in the country? Therefore, up to a limit of rupees 10 lakhs loans for studies in domestic educational institutions to a limit of rupees 10 lakhs, the government will provide 3% subvention. Currently, the government is paying 3% interest rate subsidy under home loans as well, under the so-called Prime Minister Awas Yojana PMAY scheme. Similarly, for educational institutions as well, for studies within the country, educational loans. So who are the beneficiaries? Students, of course, are biggest beneficiaries. Indian and educational institutions would be the beneficiaries. And of course, educational loan companies, companies which grant student loans, they'll also be benefited. There are two provisions for small and medium entities which are extremely relevant. Number one, a self-financing scheme for guaranteeing SMEs. Currently, SMEs are guaranteed by SIDBI. SMEs guarantees, banks giving loan to SMEs are guaranteed by SIDBI. But the government is proposing a self-financing scheme. From whatever details are currently available, the structure might be something like this. Several SMEs contribute a guarantee fee to a particular structure. This structure now forms a particular corpus. From this corpus, a lender which is giving a loan to SMEs forming part of the structure. This is what you call a pooled structure. So everyone forming a part of the pool will be benefited by the guarantee. The guarantee will be given by the guarantee fund from out of the monies collected from the SMEs itself. Becomes a kind of self-finance. It's almost like a mutual scheme. It becomes a kind of mutual scheme because insurance also started as a mutual scheme. Similar idea of several SMEs contributing their guarantee fees to a scheme, and the scheme then gives guarantees to a lender, which is giving a loan to SMEs. Very quickly, the government is also proposing that if SMEs, because of difficulties, were tagged as what is called special mention account. Special mention account is something which is not a non-performing account, something which is up to 89 days of default. The SMEs, small and medium businesses, tagged as special mention account may also get a guarantee from a guarantee scheme to be launched by the government. So when it comes to funding by SMEs, there are several benign schemes currently prevailing. There's also a TREAD scheme under which receivables can be funded on TREAD's platform. Loans granted by banks to SMEs are mostly unsecured. The banks get a guarantee from SIDBI to the extent of 75% of the loans. In addition, NBFCs giving loans to SMEs also get similar guarantee from what you call CGT SME, CGT SME, CGT MSE. So these are guarantee structures currently prevailing for funding to SMEs. Just a very quick provision about gifts by companies. There was a provision in section 47 Roman 3 which talked about gifts. Earlier gifts were not considered as transfers. Now the exemption from transfer would be available only in case of gifts by individuals, not by companies. Companies normally don't give gifts, but sometimes gifts may be given or transfers without consideration may be done by companies as a part of schemes of arrangement. So if at all a company is giving any transfer without consideration as a part of a scheme of arrangement, this will no longer be exempt from definition of transfer, and therefore it might be considered as transfer. If it's taken to be transferred, the question of taxation at fair value of the transferred asset may come, because then section 54D might capture this kind of a transfer. Finally, fund management entities in IFSC. IFSC has two types of fund management entities. A so-called mutual fund, which we know in the country we call it mutual fund. Under IFSC, it's called an FME. It's called retail FME. A mutual fund becomes a retail FME. Similarly, an exchange traded fund also, so ETF also becomes a retail FME in the context of IFSC. That apart, the non-retail, like similar to AIFs we have within India, the non-retail FMEs are called category 1, category 2, or category 3 AIFs within IFSC. Now, presently, there was no clarity about mutual funds and ETFs out of IFSC. Several banks have already formed fund management companies out of IFSC, and they're just about to launch mutual funds. This lack of clarity was hurting. The proposal now is to grant clarity and say that retail FMEs, that will be mutual funds and ETFs, will be taxed as category 3 AIFs, and category 1 and category 2, of course, are taxable in the hands of the taxpayers. They're taxed in the hands of the contributors or the beneficiaries. End result of this exercise is that in case of Cat 1 and Cat 2, the tax is paid by respective unit holders. Unit holders may either be Indian residents, because now Indian residents are also permitted to invest based on the liberalized remittance scheme. One can remit money to IFSC and invest as one would have invested outside India. So if there is Indian resident investing, whereas the investor will pay tax. If foreigners are investing, well, the tax will be paid by the respective shareholder in the respective jurisdiction. As far as the FME is concerned, retail FME is concerned, Cat 3, as well as mutual funds and ETFs, tax is payable on the fund, but that there is a provision to exempt 10 out of 15 years as per the normal scheme of taxability of entities within IFSC. So as regards category 3 institutions as well as retail FMEs, 10 out of 15 years their income will not be taxed. At their choice, they can choose 10 out of 15 years, either the initial 10 years or later 10 years. They can choose a block, and that's how the taxability of FMEs will work. So the entire structure of the budget, I would say, is backed by vision, backed by long-term honors, and
Thank you so much.
absolutely. Is there any question at all for me?
So there were a few questions. Just 1 second. So one is so this is something which has been in news also, maybe controversial. So do you think that buyback provisions would impact ESOPs granted to techies and startups? Because I've seen this buyback is a way for promoters to exit, right? So do you think that it will impact definitely, and this was brought into specially to put on a hold on such practice? Is that so?
No, no. First of all, ESOPs cannot be granted to promoters. As per SEBI's ESOP structure, ESOPs cannot be granted to promoters. ESOPs can be granted to persons other than promoters. Number two, as per Companies Act Section 68, buyback provisions of Section 68 are applicable to buyback of ESOPs also. ESOPs are normally not bought back. ESOPs are exercised. The resulting shares may be bought back, but sometimes
Yeah, yeah.
companies buy back ESOPs as well, even before the options get exercised. In which case, it's
Correct.
covered by Section 68. Taxability, however, under Section 222F as proposed, it very clearly talks about buyback of shares. ESOP is not a share. ESOP is just an option. So if at all a company buys back ESOPs, or a company buys back, like I mentioned, CCD, compulsorily convertible debentures, those buybacks would still not be hit by the proposed Section 222F, as they are anyway not hit by Section 115 QA also. Nidima,
Correct. Got it. So there is one related to IBC. Should I take up?
please do.
So how will changes in IBC and the establishment of additional tribunals speed up the insolvency resolution process?
That's a very good question, and maybe because of dearth of time, I didn't get into IBC, because this is more like a motherhood statement right now. We exactly don't know what will be the shape of IBC changes. The FM talked about two things. Number one, she said she will ease out the process of insolvency resolution by making appropriate changes to IBC. We don't know what the changes would be, but as and when the changes are available, we'll probably talk about that. Second, she said to declutter the NCLTs, which are extremely cluttered as of now, because there are common benches. They deal with Companies Act provisions, they deal with IBC provisions as well. And anyone who's dealing with IBC will probably know that during a day there are 60 matters listed, out of which the bench barely hears 10, then rises, and rest 50 are deferred. Commonly,
Mhm.
one matter is deferred 50 times. Now, this extremely long list of cases before NCLTs. The experience is no different from how it used to be in courts. Date pe, तारीख. Sunny Deol
Right.
recall. तारीख pe, तारीख. So that's what happens in NCLTs too. So we hope that with additional benches and some benches dedicated to company law matters, because after all, company law matters also go to NCLT. Particularly, let's say operation mismanagement, these matters go to NCLTs. Currently, they don't have time at all. So maybe with dedicated benches handling company law matters, the pe tarikh may become a little less tarikh oriented.
Yeah, correct. So there have been a lot of buzz in our YouTube comment session where everyone is like, buyback amendments must be withdrawn, representation must be sent to all by government. What is your
Uh,
take?
I am almost certain, Ridhima, like I mentioned, that there will be some buyback of the buyback provision. There'll be
Acha,
some
okay.
rollback. Probably there'll be some rollback, because if it stays the way it is, someone will challenge it in court. And I think a court will not take long time to strike it down, because this is going against fundamental principles of taxation. You
Right,
can't
right.
tax a person without earning income. You can't tax a person on his own money.
That is absurd. That is truly absurd.
Absolutely.
So let's hope that soon, maybe by the mid of the next month, we'll get an update on that.
ख्वाहिश तो ऐसी है.
Yes, let's see. So I think that's all. And thank you so much, Mr. Kothari, for an extensive and a thorough session.
Thank
This
you,
was
Ridhima.
a much needed session to end it on a truly high note. Thank you so much.
So very thankful to everyone, particularly the marathoners. Thanks, Taxman. Thanks everyone. Bye bye.
Thank you so much.